Investors, hello. This is Stock AI Insights, and I'm your chief AI analyst. Just a reminder, this is for educational reference only and not investment advice, as investing always involves risk. Today, we're deep diving into a fantastic piece from NPR by Bobby Allen titled, "Here's Why Concerns About an AI Bubble Are Bigger Than Ever." We're going to pull out the key market insights you need, all in just a few minutes. Okay, let's just get right to it. The entire market seems to be asking one massive question right now about AI. Are we living through a true supercycle? A fundamental shift in technology that's going to redefine our economy for generations? Or are we just in a massive speculative superbubble that's being pumped up by hype and some pretty creative financing and is just waiting to pop? That's what we're going to explore. So you really can't even begin to talk about the AI boom without starting with Nvidia. And its CEO, Jensen Huang, he's at the absolute epicenter of all of this. He tackles that bubble talk head on. His message is crystal clear. This isn't some frenzy. From where he sits, building the very foundation of this revolution, it's something totally different. And look, this isn't just talk. It is backed by one of the most incredible run-ups in value we've ever seen in market history. Just look at this number, a 300% surge in value in just 2 years. That's the market basically saying it believes Nvidia is supplying the picks and shovels for a brand new industrial revolution. And it's not just Wang, not by a long shot. You've got this powerful chorus of top-tier venture capitalists and big finance executives all singing the same tune. Venture capitalist David Sachs calls it an investment supercycle. Ben Horowitz says, when you look at the fundamentals, it just doesn't look like a bubble. And over at JP Morgan, Mary Callahan Erdos thinks calling it a bubble is just a crazy concept. The big argument from the bulls is this. Yeah, the spending is massive, but the opportunity is even bigger. It's a once-in-a-generation thing. But there's always another side to the story, right? The pushback to all this optimism really starts with this observation from Paul Kudrowski at MIT. He says, look, the technology is useful, for sure, but that breakneck, exponential improvement we saw at the beginning, he argues it's starting to slow down, maybe even stall. And that really challenges the main reason for all this investment in the first place. And the level of investment we're talking about is, well, it's just staggering. This year, just the 4 big hyperscalers, we're talking Amazon, Google, Meta, and Microsoft, they're expected to spend a combined $400 billion. A lot of that is going straight into building more data centers. For some of them, that's nearly half of their entire cash flow being poured right back into AI. Now, to really wrap your head around a number that big, this slide puts it in perspective. To make back that $400 billion, every single iPhone user on the entire planet would need to spend over $250. And as Kudrowski puts it so well, that's not going to happen. It really just shows the potential disconnect between the money going out and the actual money coming in from real customers. And that brings us right here to the reality of adoption. I mean, look at this chart. Everybody's heard of AI, lots of people are using it, but the data suggests that only about 3% of people are actually paying for it. So you see the problem, right? You've got this fire hose of spending on one side, and on the other, just a trickle of paying customers. How long can that last? And this skepticism isn't just coming from analysts, it's got some serious academic firepower behind it. Daron Acemoglu, an MIT economist who just won a Nobel Prize, he thinks that while AI will be valuable someday, the story we're being told right now is full of exaggeration. When a Nobel laureate starts using words like that, it's probably a good idea to pay attention. So if it's not all coming from cash flow, how are they paying for all of this? Well, a lot of it is debt. According to Goldman Sachs, these big tech firms have taken on over $121 billion in debt just in the past year. That's a more than 300% increase from what they'd normally take on. So now we're introducing a whole new word into the conversation, leverage. And here is where it gets really fascinating from a financial perspective. Some of this debt is being structured using some pretty complex tools. One of them is called a special purpose vehicle, or SPV. Think of it as creating a totally separate little company just to hold specific assets and, more importantly, liabilities. The neat trick is that it keeps all of that off the main company's books. It's a bit of financial engineering. Okay, let's look at a real-world example with Meta. So Meta partners with a firm called Blue Owl. Together, they create one of these SPVs to build a data center. Blue Owl then goes and gets a massive $27 billion loan to fund the SPV. Now, Meta leases the whole facility, so they're guaranteeing the debt. But that $27 billion, it doesn't show up on Meta's main balance sheet. So what's the benefit? Meta gets all the computing power at once, but it looks like it has less debt. The risk, of course, is that Meta is still on the hook for those billions if things go south. And this is where a little bit of history sends a shiver down your spine. Analyst Gil Luria points out that the last time the term SPV really entered the public conversation was about 25 years ago with a company called Enron. Now, to be clear, today's deals are transparent, but it's still a huge red flag for analysts when a boom is being funded with these kinds of complex financial instruments. So beyond the debt, there's another pattern that's raising eyebrows. It's this circular flow of money. It's almost like a snake eating its own tail. The investment money just goes around and around in a closed loop, which can make it look like there is way more real customer demand than there actually is. Let me show you how it works. Nvidia puts money into OpenAI. OpenAI then turns around and uses that same money to buy chips from Nvidia. Or OpenAI cuts a deal with a data center company called CoreWeave, paying for services with its own stock. This is how you can inflate a bubble from the inside out. The revenue looks real, the demand looks real, but a lot of the money is just moving between partners, not flowing in from new outside customers. So what's the big deal? Well, it's all about systemic risk. The Nobel laureate Darren Acemoglu comes back with this warning. A system built on these kinds of self-funding deals can turn out to be a house of cards. It all looks solid as long as the money keeps flowing in that circle. But if real customer demand doesn't show up to replace it, the whole thing could become really unstable, really fast. And all of this leads to a pretty powerful comparison with history. Does any of this sound familiar? In the late 90s, companies took on billions in debt to lay fiber optic cables all over the world for an internet future that wasn't quite there yet. We all know how that ended. Today, companies are taking on billions in debt to build data centers for an AI future that isn't guaranteed. Analyst Gil Luria explicitly warns that if we overbuild, this could trigger another financial crisis. This feeling is shared by some of the most famous bears on Wall Street. Michael Burry, the guy from The Big Short, he doesn't mince words. He says true end demand is ridiculously small and claims that most of the customers are basically just being funded by their own suppliers. But maybe the most stunning warnings aren't coming from the critics. They're coming from the people building this thing. Sam Altman, the CEO of OpenAI, the company that kicked this whole thing off, was asked straight up if investors are overexcited about AI, and his answer was a simple, my opinion is yes. And he's not alone. Google's CEO, Sundar Pachai, also admitted that he sees elements of irrationality in the AI market. I mean, think about that. When the CEOs at the very heart of the revolution are using words like overexcited and irrationality, that's a pretty strong signal that things might have gotten a little out of hand. Which brings us to our final and most important question. If the leaders of the AI revolution themselves are seeing irrationality, what should a smart investor be seeing? The key takeaway here is this. The AI revolution is absolutely real, but it's being financed with complex debt and circular deals that have echoes of past bubbles, a risk that even its biggest champions seem to acknowledge. Let me know what you think in the comments. I'll see you next episode.